In this week's Fastest 4 Minutes in Finance, don't let your politics guide your investment decisions. Hello, and thanks for checking out this week's segment. I'm Scott Inman. Well, it happens with pretty good frequency in our meeting rooms. Clients become fearful about staying invested in the stock market during an election year, especially if they think their candidate is not likely to win. And it is true that the market likes certainty, and there can be short-term volatility if there is uncertainty about who will be the next president. An extreme example of this was 2016. Maybe you remember that Democrat Hillary Clinton was perceived to be the winner of the presidential election based on polling leading up to Election Day. Donald Trump, the Republican, pulled off the upset that evening. Stock futures then tanked because it was so unexpected. But by the time the trading day got underway, stocks reversed course and began a rally. The market needed time to digest what it meant to be wrong. But at the same time, history shows us that in the longer term, the stock market actually performs well in all election years. Take a look at this chart from LPL Research. It shows the average return for the S&P 500 index during the different years of a presidential term, dating all the way back to 1948. As you can see, by focusing on the blue bars, all years are positive in the long term, and you might expect that. The best year has been during year 3. The S&P has averaged a whopping 17.2% annually in year 3 of a president's term. Now look at the diamonds above the blue bars. This shows the percentage of times that the particular year of the term was positive. Year 3, for example, has been higher 89.5% of the time. Year 4, which President Biden is currently in, has averaged 6.9% annually since 1948 and has been positive 78.9% of the time. But now let's focus on the orange bars. This breaks down year 4 of the president's term by distinguishing whether a president was running for re-election or not. If the incumbent was on the ballot, as Biden is this time, stocks have been up 100% of the time, 10 out of 10 instances, and the average annual return has been 12.5%. That certainly is a different story if the president is not running for re-election. You can see the index has been up only 1.7% annually and positive only 60% of the time. Keep in mind, these historical averages are not taking into account who wins the election. This is simply identifying the environment we are currently in. Now, finally, digging a little deeper into the data, we find that when the sitting president is a Democrat, as Biden is, market returns have been higher during an election year overall than when the incumbent is a Republican. And that's regardless of if they are running for re-election or not. The number is skewed, though, by the 2008 financial crisis in which Republican President Bush was the incumbent. If you take that year out, the returns are actually very similar, no matter the particular party of the incumbent. As LPL Research writes, the stock market might be more likely to respond to the economic cycle than party politics. In general, that is the way these go, which means do not let politics disrupt your long-term investment plan. Thanks for watching. Thanks for listening.